Good afternoon, ladies and gentlemen. Welcome to today's webinar. It's webinar 6 in the series of COVID-19 discussions on tax. Today we're going to talk about the impact of COVID-19, the economic impact of that, the lockdown periods, and what that impact on the large corporate from an income tax and a VAT perspective. The reality is, even though there is some relief for taxpayers, individuals and companies during the COVID-19 period, there's not a lot of amendments to the Income Tax Act and the VAT Act. From an income tax perspective, it's mainly the postponement of the PAYE obligations in terms of the fourth schedule, the provisional taxes, and the only real changes in the law was to Section 18 Cap A for contributions made to the disaster trusts. And to exempt them from tax in terms of the PDO legislation for 3 months, and then thereafter also provide them with exemption more permanently. So, but that doesn't mean that there are no unique challenges to this period. In this period, there are many challenges that companies need to face, and they need to apply the normal legislation. And the purpose of today's webinar is to explore certain events and how that can impact on the large corporate. So I've prepared 9 case studies, and then lastly I'll be talking about some assessed losses. So in case study 1, I'll be talking about operational capital allowances during the lockdown period, and then if there is certain conversion costs to manufactured masks. And in case study 2, I'll be talking about the deduction of initial fees that a franchisee is claiming during the lockdown period. Case study 3, interesting, we're talking about valuation of trading stock for motor dealers. 4, the conversion of debt to equity and compromise with creditors that may happen. And 5, raising international group finance. Case study 6, some closure costs. What will happen if a company needs to close down? The payment and receipt of fees to cancel franchise agreements, and that can also apply for certain cancellation fees if you need to cancel rents, long-term lease agreements, and the like. And case study 8 talk about the tax treatment of due diligence costs and related costs if companies are believing that this is a good opportunity to actually acquire businesses at bargain purchase prices. And then case study 9 will explore certain problems in the sale of businesses as going concerns, and then also the acquisition of businesses as going concerns. Let's start with case study 1. And under this case study, let's assume your client operates several limestone mines and uses the majority of the limestones so obtained in 2 large cement factories. So it's got a mine and it has got a manufacturing operations in the factories, all in one company. The taxpayer is obligated to close the mines as well as the factories for the 5 weeks during the lockdown period. And clearly, this kind of business, the taxpayer is capital intensive, and they approach you and require your advice regarding the capital allowances that will be claimable in this period. So they also want advice regarding the normal operational expenses. And then they ask you, they're saying that up to 2 years ago, they used to manufacture their own masks for internal use in the cement factory. And considering with some restoration, repairs, and minimal additional investment that they can make about 100,000 masks for COVID-19 purposes in the next 3 months, and thereafter they'll close it down. But they're prepared to do this as a public interest initiative, and they'll make a loss of about 500,000 rand on its in totality. So let's go through certain sections in the Act and just see how this can impact all of this. Clearly, one always starts with Section 11A, and we're all familiar with Section 11A, saying you can deduct any expenses in the carrying on of a trade as long as it's not capital in nature and it is in the production of income. So clearly, if you are a 5 weeks temporary shutdown is definitely not a cessation of trade. If one closes down in this 5-week period and then restart the business, then there should not be problems with the trading. However, if a company is stopping in totality, then there is clearly a cessation of trade. But what about the 500,000 rand loss that the company was making in the face mask? So clearly there must be, for costs to be deductible in terms of 11A, it must be in the production of income. So if the expenses, the salary and operational expenses and the cost of the of the stock would exceed the anticipated income of 500,000 rand, then there is a risk that 500,000 rand may not be tax deductible as being a unproductive expenses in terms of 11A. So the company should try and obtain as much as possible marketing through this, and actually say that they are doing this in order to place the company in a good position, to raise its market profile, and to be seen as a good corporate citizen. This leads to a question that if companies are doing this kind of things, they should actually be encouraged to do it, and that those losses should be tax deductible. One should also see how those losses are being made. So if my client would approach me on this question, I will ask them, how is the 500,000 rand losses made up? If they're at least covering the variable costs, then it should be okay, because at that stage you are covering your additional salary cost, the direct costs of manufacturing. So if the client has, in calculating the 500,000 rand, has taken overheads into account and the like, then perhaps one can say, listen, you should not be doing that. One should only be covering your variable costs when one look at the tax deductible in terms of 11A. But on the face of it, there is a potential risk of a denial of the 500,000 rand under this scenario, and one should do a bit more work and see that it is tax deductible. Let's go to section 11E. And 11E, you're all familiar with it as well, but essentially you have a discretionary allowance over the useful life of an asset, but the requirement must be, and it's highlighted in red, and used by the taxpayer for the purposes of his or her trade. Let's see what interpretation note 47 says about the use requirement. It says the allowance is deductible only to the extent that the qualifying asset is used by a taxpayer for purposes of his or her trade. The asset will be written off over its useful life. An asset held in reserve will therefore not be claimable in terms of 11E because it is held and it is not used. So on the face of it, there is a risk that if you close down your business, whatever business it can be, that over that period, SARS can say you're not allowed a 11E deduction because you're not using that asset during that period. And obviously it will create a bit of an absurd result. So it can also differ based on the impact, economic impact of this can also differ based on the type of asset that you have. So let's assume your year end is 30 April. So you've been closed down from 26 March, and by year end, by 30 April, you've not yet commenced. You'll only start operating again on the 2nd of May. So for more than a month, you've not used any assets. It's just been standing there. So there is a real risk that by 26 March, you should stop depreciating any assets under 11E. And I don't think that is clearly in line with the intention of the law. But this is the way that there is a risk of that being applied in that format. But let's assume your year end is actually 30 June. So during the period, you've now started operating again. So in May, so you've operated in May and June again. And then the question comes in, can you do a bit of a catch-up claim? So let's assume it is a computer that you're using. And by 30 June, the computer will be exactly 2 years old. Does that mean you can... And the write-off period for the computer is 3 years. Does that mean you can claim everything up to a tax value, meaning that at that time it should have a third of its expected life left, and therefore I'll be effectively claiming a bit of a catch-up? And you look at what the market or what the tax value would have been. Personally, I believe that can apply when the asset's expected life is dependent on things like technology. A computer is dependent on technology, and that can be applied on that basis. So I think for something like a computer, so because of technology, after 3 years, it should have a zero value. Should really be replacing the asset. So after 2 years, it's really got 1 year left. So a bit of a catch-up claim, and nothing prohibits in law a catch-up claim under 11E. SARS may exercise discretion of allowing it, but nothing in law prohibits you from claiming it. So if you've got a 30 June year end, and the type of asset is a technological asset or something that is dependent upon certain things other than just use, that can be differentiated from, example, assets used in a gym. So in a gymnasium, if you've got a exercise bicycle there, it will be used, and the expected life of that exercise bicycle is not really dependent on the technology. It is more dependent upon how many times it's being used. Now, if that gym has been closed for 5 weeks, SARS may argue to say, but hang on, its expected life will then be longer by the 5 weeks. So technically, there is a risk that SARS may disallow it, and I think personally, SARS should just issue a media statement saying that 11E deductions will not be prejudiced purely because it has not been used in this period. That will create a lot more clarity, because as you can see, one can argue it either way, and the question is, how will SARS exercise discretion? There should be some certainty in this regard. This can also obviously impact your provisional payments that you need to make, and at what level do you have to get to actually pay your provisional payments. Let's also go to section 36. Our client in our example is operating mines. So section 36 is quite relevant for that client. What does section 36 says? In 7C, it says that the amounts to be deducted under section 15A from the income derived from working or producing a mine shall be the amount of capital expenditures incurred. So this allows a mine to claim a full deduction for any capital expenses. So that sounds very nice, but then there is a ring fencing requirement 7E. It says that the aggregate of the amounts of capital expenses in respect of any year of assessment, in respect of any mine, shall not exceed the taxable income from that mine. Anything else would then be carried forward and be regarded as mining capex. So if you incur mining capex, you can only claim it up to the taxable income of that particular mine. So if you're operating different mines, then it's ring-fenced to the taxable income of that particular mine. If you're earning non-mining income, for example, interest, or in this case, income from the factory, you can't offset that mining capex against the non-mining income. So what is capital expenses? Capital expenditure is defined, and it's a lot of this whole section dealing with it. I just copied A and B in this. A says expenditure on shaft sinking and mine equipment. Okay, so it's quite general. But then paragraph B talks about the expenditure on development, general administration and management, including interest used for mining purposes prior to commencement of production, which is okay, or during any period of non-production. Now that's quite clear. Expenditure on general administration and management, including interest on loans utilized for mining purposes during any period of non-production. It's law. It's law. So a factual question is, during these 5 weeks, what did the mine produce? Was there any production during this mine? And the answer must in many cases be no. There has been no period of non-production. So technically, in terms of the law, that will then be regarded as capital expenses, including the interest, including the general administration management, and it can only be set off against taxable income from that mine. So if you then earn non-mining income, you are not allowed to deduct this against the non-mining income. So clearly, that is against the spirit of this period, and a legislative change is probably required, and something that SARS or the National Treasury should consider doing. Let's look at other sections, because clearly the company in our example has got a factory, so they may be under 12B, there may be energy, solar-powered energy plants or things that may qualify under 12B. There may be 12C, manufacturing equipment, section 13.1, buildings used in process manufacturing, and 13.1 other buildings as well. Now, all of these sections should be okay, because you get it and it's not a portion for a part of the year, and as long as you are using it for 1 day in the year, you can actually get the deduction for the total period. So a 5-week lockdown period should not adversely affect any of those deductions. So that all of them should be okay. Let's look at section 11D. So what we said is that the company had a facility where they made their own masks, and it's been effectively mothballed about 2 to 3 years. And they say, well, with a little bit of investment, a little bit of split and polish, we can get this thing going again, and we can manufacture quite a number of masks for public. So let's look at what section 11D, repairs and maintenance, actually says. Now, it's important that 11D should be distinguished from the accounting treatment of repairs and maintenance. From accounting, many things that for tax perspective, we will regard as a tax deduction in full on 11D, for accounting purposes, would be capitalized and then spread up over the useful life. The question from an accounting perspective is are you actually expanding the useful life of that asset by repairing it? If it is yes, then you will then capitalize it and depreciate it over a longer period. 11D is not concerned on whether you are extending the useful life of it. It's clearly you're extending the useful life of it. The question is, are you just bringing it back into its original form? So if you bring it back to its original form, then you can claim a tax deduction. There's also a misconception because 11D is nothing more than a capital allowance. If it wasn't for 11D, there would have been a denial of an expenses. It can't qualify for 11A because a repair and maintenance on a capital asset is a capital expense. By definition, it's a capital expense. In the absence of 11D, you cannot get a tax deduction. There's often, I see incorrect wording in documents that says you can claim a repairs and a maintenance because it's an operational expense. Because it's not a capital expense. You can't say that. It is a capital expense. The question is, does it fall within the provisos of 11D? So I've prepared this little bit of a mind map that can help us go through 11D. And the first question is, was there a deterioration of the property because of use? So you've had that plant, you've used the plant to historically make masks for use in the factory, for the cement factory. So clearly the property that was in that little plant there did deteriorate because of use. So if the answer is no, then you have to say that 11D is not applicable, and then any expenses you need to test under 12C, 11E, 13.1, 13, like. Okay. If the answer is yes, there was a deterioration in use, then you say, did the repair result in an improved asset with improved income earning abilities? And that is very much a tax question. And it says, if, for example, previously you could produce 100 masks per day, and now you can produce 200 masks per day, then you'll have an improved asset, an improved facility, improved income earning ability. Also, if the actual mask that you're producing is better than what you previously did, but if it's more or less the same thing, it should not be a major problem. So you can argue that I used to have this facility, it produced masks, and with a little bit of repairs and maintenance, I can just resuscitate it and do this again. So one can argue either way. If you can produce more masks or different masks of different or better quality, then it may actually fail that test because it's an improved asset. And in normal situations, for example, if you repair a building and you had carpets and you replace that with tiles, you're not necessarily increasing the footprint of the building. So you can use different materials. If you had a tile roof and you replace it with a corrugated iron roof, it would be okay. You can use different materials because the footprint is not increased. The moment that you increase the footprint, the moment you increase the income earning capacity, then it is different. For example, if you're replacing a copper cable with a fiber optic cable, that is increasing the capability of that cable to take, for example, telecommunication messages. Okay, so in this case, let's assume no, we could produce exactly the same number of masks as now. Then the question comes in, did the repair constitute a replacement of a subsidiary part of the whole, or did it consist of a replacement or substantially the whole? So one of the requirements is that a repair is only a subsidiary part of the whole. So for example, if you have a hammer and you replace the handle and you replace the front bit, then you're replacing the whole hammer. You've got a new hammer. The same thing, if you have, for example, run a bus company, and you want to repair the bus. So if the bus you're taking, you're only keeping the chassis, you're replacing the gearbox, you're replacing the engine, you're replacing the bodywork, you're putting new, you're repairing substantially the whole. You've almost got a new bus. You're only keeping a little bit of the stuff. Then you don't have a repair. You've actually got an improvement and a new bus. So it's a question of degree. So in this case, if the whole thing fell into disrepair, you had to effectively replace a whole bunch of assets and everything in order to resuscitate this whole thing, then it can be substantially the whole. If it is no, we've just got to repair certain machines here and certain pipes there and put different things on, and it's a subsidiary part, then it could in fact be a repair. So it's a subsidiary part of the whole, then it can be 11D. So there is an opportunity in that case where if you've already made masks and you're just resuscitating again, and maybe you're making different type of mask, but it's not much, and you just need to repair it back to operating order, then it should be okay. But if there are costs that could be It's probably in this scenario a bit of a combination of both. You probably will have your repairs element, and then you'll also have a bit of a capital element. Also remember now, the 11A, so if there's unproductive expenses, must all be in the production of income store. Also look at 11G. 11G is your so-called leasehold improvement sections. And I thought I'll bring it in, even though in the scenario we didn't specifically mention that the company is leasing any property, but just because it's of generally not applied correctly. So often I have people saying to me, but I am entitled to effect certain improvements, and therefore I'm claiming a deduction for my leasehold improvements. Now, this is not correct, because 11G says that you can, if there is an obligation to effect improvements on land and buildings. Now, the entitlement to effect leasehold improvements is quite different from the obligation to effect those leasehold improvements. There must be an obligation. If you merely have to inform the landlord that you're going to do improvements, is not an obligation. The agreement that you have must be you are obligated to erect a wall, to build a building, or to do whatever you want to do, or had to do. Then you can take it, and then you can get a deduction over the period that you're entitled to use the period, but it cannot be more than 25 years, over the period of the lease, or not more than that. So the vast majority of things that are deducting 11G actually falls foul and doesn't even qualify for that. From a practical perspective, often what happens is, for accounting, things will be classified as leasehold improvements, but from a tax perspective, is actually not a leasehold improvement. A leasehold improvement is only something that by the law of ascension actually fixes to the property. So if the manner in which it's fixed makes it permanent, if the intention is that it's permanent, then it becomes part of the property. So for tax purposes, only those kind of things. But if you've got movable assets that you have on leasehold property and you just incorrectly classified. So, for example, Proxima that you have in a building, and you classify that Proxima as a leasehold improvement. It's not leasehold improvements. It's a loose asset. It's a loose asset. Some furniture and fittings, the same thing as well. Those assets you can claim under 11E. But if you do claim under 11G, then the fact that the company has now ceased to produce for 5 weeks doesn't preclude you from claiming 11G deduction, because you're still entitled to the use of the occupation. The moment that you stop the entitlement to the use of occupation, then obviously you can't claim that deduction anymore. On a side remark, often when you do vacate your leasehold property, either by agreeing to vacate it, or also just by the lease agreement has come to an end, then whatever leasehold improvements you have not claimed, did not qualify for claim, you can get a capital loss. So don't forget to claim that as a capital loss. All right, so that is your case study for the large company just wanting to find out about its capital allowances. And clearly there's a potential problem with the application of 11E, and there's quite a definite problem with the application of Section 36 if a mine is not producing. So the second case study, let's assume your client operates a franchise stores under the well-known pizza brand. And it opened 5 stores, and they started operations in October 2019. So it's quite new, and they are now temporarily closed for this 5 weeks. So the client paid initiation fees, and they ask you now, what is the treatment of this initiation fees? So fortunately, Section 11F comes to the rescue of the taxpayer, and SARS have also issued a binding ruling in this regard. So 11F says an allowance in respect of any premium or consideration in the nature of a premium paid by taxpayer for the right of use of any patent and design and copyright and certain knowledge and any property of a similar nature. And that right of use you can get over the period of the right of use. Now, binding private ruling 285 dealt with this specifically, and it says that the initial fee to be paid by the franchisee can be claimed over the term of the initial agreement. Okay, and as I said, it may be claimed for the right of use. Now, the fact that you are not operating and have closed down your pizza shop for 5 weeks doesn't mean that you don't have the right of use of all the knowledge and the know-how and everything to do that. So there should be no problem in claiming 11F over the 5-week period as well. Okay. This is a very important aspect over this period. And let's assume this case study. So your client buys and sells second-hand vehicles on large scale. At the year end is 28 February 2020. So it's just before everything started spinning out of control. At year end, so to that point, it was business as normal. They normally buy stock, and they knew that it's going to sell the stock, and it buys second-hand vehicles from the public, and then it had to then sell it. So at that point, it had, let's assume, stock on hand of 250 million rand. Then the economic impact of COVID-19 has a significant impact on the second-hand car market. People don't have money. They have lost their jobs. They don't get loans. The National Credit Regulator prohibits them from borrowing money to buy cars. And they look at this, and the company classifies its vehicles in 3 buckets. It's got a bucket for vehicles up to 100,000 Rand with a cost up to 100,000 Rand. It's got a bucket of vehicles between 100,000 Rand and 200,000 Rand, and then it's got a bucket of vehicles over 200,000 Rand. So it says for all the vehicles that's on hand up to 100,000 Rand, they still believe they can sell it at a margin of 5%. So normally they'll make a margin of 15%, but the cheaper cars will still go because people may be buying down, people still need to be mobile, and they still believe they're going to make money on it. So they're expecting a profit of 40 million Rand on this bucket. The vehicles between 100,000 to 200,000, I think they're going to sell it at a 0% margin, just to break even. No profit on it. The problem comes in with the more expensive vehicles over 200,000 Rand, and they're actually expecting a loss on this category of stock of 20 million Rand. So when you look at the overall stock position, with the cost of 250 million Rand, clearly if you take the swings and the roundabouts, they're still going to make a 40 million Rand profit on the lower value vehicles and a 20 million Rand loss on the upper end vehicles. So overall, still expecting to sell those vehicles for 270 million Rand, which is up obviously much less than what it would have been. But in terms of your accounting provisions, they now need to make a provision for the 20 million Rand being the losses on the category 3 stock. Okay. So now the question comes in is that when now do the tax return for February 2020, can you claim a stock obsolescence provision for this 20 million Rand? Okay. So first one, you have to go to the definition of trading stock. So trading stock, it says it includes anything produced, manufactured, constructed, assembled, purchased or in any other manner acquired for the purpose of manufacture, sale, exchange by the taxpayer or on behalf of the taxpayer. So it's your raw materials and the like. Category 2, anything that proceeds from the disposal of which will form part of the taxpayer's gross income. Okay, so that would be you're buying stock. In this case, it would fall into that category. You're buying cars with the purpose to sell it, and because it's your trading stock, you will pay tax on it. The third one is quite interesting. Consumable stores and spare parts acquired by taxpayer to be used for consumed. So your consumable stores, that's your fuel and everything that you have. You're not using that in order to sell, but using it in order for consumption. And then spare parts is spare part for capital assets. So if you have a big machine and you need spare parts for the big machine, that spare part is deemed to be trading stock for tax purposes. Okay, but we're not dealing with that now. We're dealing with category 2. And then section 22 talks about the amount to be taken into account. So even currently, it's still a discretionary allowance. Since 2015, the draft legislation is just waiting for the effective time to be implemented, where that discretion of SARS will go away. But it says that the amount which shall, in the determination of the taxable income, be taken into account shall be the cost price to such person of such trading stock, let such amount as the commissioner may think just and reasonable as representing the amount by which the value of such trading stock, not being in financial instruments, so it doesn't apply to shares and like, has been diminished by reason of damage, deterioration, change in fashion, decrease in market value, or for any other reason satisfactory to the commissioner. Okay, so quite wide, it is subject to the discretion of SARS. So the most important case law is the appeal court case of SARS versus Volkswagen. Now, Volkswagen won the case in the in the special court case and lost the case on appeal. And it's quite interesting the different routes of argument that happened. So let's just go through what happened on the special court. So in the special court, in this case, what the topic was Volkswagen imports vehicles, for example, Audis, from overseas, and the vehicle will be landed in South Africa. So let's assume you have an Audi, and the landed cost would be 500,000 rand for the Audi. So what Volkswagen would do in terms of the relevant accounting standards, it will say, okay, I can sell this vehicle for the cost of 500,000 rand. I can sell the vehicle for 550,000 rand, but this vehicle has got to be delivered to the dealer. So to deliver to the dealer, it's going to be another 5,000 rand. I have to maintain this vehicle for the next 5 years in terms of the motor plan. So the present value of that motor plan is maybe 60,000 rand. So it brings it down from 550 to 545, maybe another 60,000 rand down. So now below 500,000 rand. In addition, there's a warranty, so I'll have to make a warranty. So the present value of the warranty, if allocated to per vehicle, is another 10,000 rand. These are purely ad hoc numbers. In addition, I have the roadside assist. That will be another 5,000 rand. So at the end of the day, even though you can sell that vehicle in the market for 550,000 rand, when you deduct, and I put it in inverted commas, when you deduct the motor plan, you deduct the delivery costs, you deduct certain other costs, you get to maybe a number of 470,000 rand. And Volkswagen will make a provision of 30,000 rand against that. So that was the topic. The SARS just disagreed with the whole thing. They just denied the entire 30,000 rand provisions. Went to the special court. The special court said, clearly, one should take into account all of this. And the special court, and it needs to be remembered, in any case that deals with the discretion of SARS, the only way you can object against the discretion of SARS is that the discretion has been exercised mala fide, or SARS did not apply their mind at all. They did not exercise discretion at all. In the special court, it was found that SARS did not exercise the discretion, and then the special court would then exercise the discretion in its stead. Okay, so in that case, the special court then said, well, the fact that SARS didn't exercise discretion, I will then exercise discretion on its behalf, and by doing so, I believe that the accounting treatment is reasonable, and I'll then follow the accounting treatment. Okay, so it is not that is actually, it is the process of the fact that SARS didn't exercise discretion. SARS took this directly to the appeal court, and SARS won the case on the appeal court. So let's see what the judge says in the appeal court. And this is very, very interesting. So these are extracts from the court case itself, and they make a difference between the NRV and market value of an asset. Okay, so it says the calculation of NRV was based on a standardized wholesale selling price for each vehicle. Similarly, the amounts deducted from that figure were standard amounts in respect of each vehicle model. So there was standard pricing. An NRV adjustment was when the NRV was less than the cost of each item of stock. The overall deduction in respect of NRV was made in respect of those vehicles only. Now, this is interesting. There's no suggestion of an adjustment in the opposite direction where the NRV was higher than the cost price. Okay. This accords with IS2, which is obviously the accounting standard, Clause 29, of which requires that NRV must be determined item by item unless that is impractical. In that way, any shortfall likely to arise when a stock item is sold is identified and accounted for immediately, but no account is taken of surpluses that are likely to be arised on other stock items. So, applying IS2 in my previous example, on my category 3, I will make a 20 million rand loss, and I have to, in terms of IS2, provide 20 million rand loss. But now, that prevents a trader from claiming profits in respect of sales that have not yet been taken into account. So, now, the judge says, while understandable from an accounting perspective, from a taxation perspective, there are problems with this approach. The fiscus is concerned with the value of trading stock as a whole. That is very interesting because in our previous example, between the three categories, under the category 1, we make a 40 million rand profit. Category 2 will break even. Category 3 will make a 20 million rand loss. For the trading stock as a whole, we'll make 20 million rand profit. So taking the argument, what the judge is putting down, even though it didn't actually fit in, it says writing down the value of part of the stock to NRV ignores the fact that NRV of the remaining stock is higher than cost price. The overall position with a company that is a going concern will probably be that the NRV of the trading stock taken as a whole will be greater than the cost price. In a solvent and profitable trading company, it would be surprising if it were not, because obviously in this case, there's obviously certain issues. Now, using NRV is a legitimate approach from an accounting perspective. However, I can see no reason for the commissioner to accept the Volkswagen trading stock had diminished in value on the basis of a calculation where Volkswagen took advantage of the swings where the NRV was lower than cost price, but disregarded the roundabouts where the reverse was true. For tax purposes, the question was whether Volkswagen trading stock as a whole had suffered a diminution in value. I must disagree with the judge in this, because clearly that is different to what SARS have always applied. You need to value trading stock. You need to value trading stock at cost, but then they can reduce it if it's less than the cost. I can't see how SARS can prejudice a company in my situation purely because I have stock items that may offset the value of the other stock items. This takes a holistic view, and I've never seen SARS actually applying it this basis, but it's quite interesting that the judge will look at it from a total perspective. Taking this course of action, that will mean that your client will actually have no deduction because it's still going to realize its full stock of 250 million at more than the original cost. This will make it quite absurd, but I've not seen SARS applying it at all, and hopefully sanity will remain. But this is in the appeal court case. Not that this specifically was part of the problem. Okay. What the judge did is to make a distinction between fair value and NRV. So under paragraph 51, the judgment says IS2 makes the point that NRV is different from fair value. So NRV is different from fair value. The latter, being fair value, is the amount for which an asset could be exchanged or a liability settled between knowledgeable and willing parties in an arm's length transaction in the market. The passage quoted from Volkswagen Notice of Objection appears to confuse the two. It says fair value reflects the current value of the goods in the market. It's the current value at year end. So at 28 February 2020, your example, what is the current value of the goods in the market at that point in time, before COVID, before anything? NRV reflects the amount it thought it will realize the market at some future date. So when you may take into this into account for your IAS purposes, the fair value at 28 February would not be taken that into account. So fair value seems more closely related to an assessment of the value of trading stock at a specific point in time. So the judge says we need to look at fair value and not NRV. Apart from these practical difficulties, the use of NRV is inconsistent with two basic principles that underlie the Act. Okay. The first is that taxable income is determined and taxation levied from year to year on the basis of events during each year. The Commission is not concerned, save where allowances such as depreciation for future years, is not concerned with any future years, the trading prospect for later years. The principle is sometimes expressed by saying that taxation is backward-looking. So, by contrast, NRV is explicitly forward-looking. So the source, as a matter of principle, the judge believed that you can't apply IAS2 because IAS2 is forward-looking. IAS2 needs to say, what's your net realizable value in the next year? It's forward-looking. When you've got to look at Section 22 valuation as looking at the year end, it says it is concerned with the amount that a trader is likely to receive when the goods are realized, and for that reason, it takes into account the expenses that will be incurred in making the sale. Okay. So the second inconsistency with the principle is that using NRV has the effect that expenses incurred in future tax years in the production of income accruing to or received by the taxpayer in the future year become deductible in a prior year. So what he does is say that is inconsistent with the basic deduction in Section 11A of the Act. Now, this is a conceptual problem for me because it talks about allowing Volkswagen to deduct in a current year expenses that will be incurred in the following year in earning income flies in the face of that provision. Okay, now Section 11A is not applicable. Section 22 is applicable, but is it really a deduction? Let's quickly go back to what you need to take into account as Section 22. Now, Section 22 is an inclusion income. it requires you to include an amount. It requires you to include a net amount. It does not include trading stock minus a deduction. It doesn't say you must include the cost of trading stock into taxable income. And then as a separate, you can deduct from the cost of trading stock an amount. It requires you, the wording of 22(1)(a) requires you to include a net amount being the cost less a net amount. So my view, it is not an inclusion with a deduction. It is a net amount that you need to include. Okay. So it is a bit of a problem in that regard, because the whole court case was talking about claiming a deduction. How can you claim a deduction for future motor plan costs? Now again, there's a conceptual problem, because SARS does, or the judge does say, you've got to look at the market value of that vehicle at year end. Now you have to remember that the Audi on stock on Volkswagen's floor, as it has landed, is a vehicle without a motor plan. So if you landed with 500,000 rand, that is a vehicle without a motor plan. If you say, but I can sell that vehicle for 550,000 rand, it's not the same vehicle. It is the sale of a vehicle on steroids. It's the vehicle sold with a 5-year motor plan. So you have to say, if I want to compare apples with apples, then what can I sell that vehicle for at year end without a motor plan? Obviously, that price can't be 550, because the price of 550 is a price with a motor plan. You have to discount the price and if the answer is at year end, as at year end, you can only sell that vehicle for 480, then clearly the event has already happened. But it's comparing apples with apples. And the whole debate in the court case talked about claiming a deduction for future motor plan costs. It's nonsense. It is comparing apples with apples, and the vehicle that is landed is a vehicle without a motor plan. To get a comparable market value at that point, a fair value, you would say, how much can I get for a vehicle that I sell without a motor plan at this point in time? So the whole argument goes out of the room. So the judge did say that there could be an element. So to the extent that the vehicle has been damaged, and again, just on careful consideration of the items making up NRV calculation, it appears that only possibility is that in that regard would have been damage to vehicles justifying the rework refurbishment claim. It's not a claim. Again, it must be said, at how much can I sell a damaged vehicle today? The Audi that is there on the floor that is damaged. The question is, can you sell that at a price equivalent to an undamaged vehicle? No, you can't. In order to get to a equivalent value for a damaged vehicle, because you need to say what is the fair value of a damaged vehicle. Okay, it is not a deduction. It's very unnecessary that this court talked about the deduction of this. It's not a deduction, because it's all about getting a fair valuation. But anyway, it is an appeal court case. It's got to be applied. So, in principle, I do agree with the fact that there's a difference between NRV and fair value. There is certain costs, like, for example, the cost to get the vehicle to the dealer. That is a future cost. One can't include that. But, for example, the motor plan, one should have that in. So how can we apply this now to our case study? In our case study, as at 28th February, COVID-19 hasn't happened yet. So there was no lockdown yet. There was no understanding that would have been such a big issue. That's a post-balance sheet event. I do not believe that you can take that into account. Okay. I do not believe that the judge was correct in saying you have to take the 40 million rand profit I'm going to make in vehicles below 100,000 rand, take that into account when determining what the overall stock obsolescence provision would be that SARS have to take into account, because that will make a fallacy of the whole scenario. So I do believe that one can take into account everything that has happened and all the information that you do have available on 28th February. I think everything that happened after the end should be non-admissible. But let's see what happens in practice. It will also be interesting to say, let's assume your year end was not 28th February, but your end was 28th March. Then obviously on 28th March, the lockdown has already been. At that point in time, it was a 3-week lockdown, not a 5-week lockdown. But you already knew it will have an impact on the market. You already knew that second-hand car prices is going to be adversely affected by this lockdown. The economy is. So in that case, if the year end was 1 month later, 31 March, your valuation of your stock could be different. If it's 2 months later, it's at the end of April, even more so, because then you'll have more clarity on it. Okay? So it's an interesting case, but it's subject to the discretion of SARS. But it would be unfortunate if SARS does apply the case, especially when with regards to just look at the valuation of stock as a whole. Okay. Now, this is also a thing that will happen quite often in this period, is restructure of debts and compromise with creditors. So let's look at case study 4. So let's assume your client runs a transport shuttle service between major centers in South Africa. It leases or owns outright approximately 150 vehicles, which ranges from minibuses to 28-seater buses. Since the middle of March, the business is effectively grounded to halt and some significant cash flow problems experienced. The leases still need to be paid, depots need to be maintained, certain salaries need to be paid, the like. So the managing director approaches you and asks advice regarding the following transactions. So it seeks a compromise of debts with unconnected third parties. So, for example, going to the banks and saying, listen, I know I still owe you so much. I want to reduce that liability. Formal compromise of debts that I may have owed you R1 million. Let's just write off 500,000 Rand and I'll pay you 500,000 Rand. So, in addition to that, it seeks to convert a loan from its major shareholder to equity in order to strengthen the balance sheet and avoid trading under insolvent conditions, because now it's going into insolvent condition situation. So you're required to advise on the tax implications. So in this one, need to look at Section 19 of the Income Tax Act, which deals with the income tax issues, recoupments, and the like, and then also paragraph 12A of the H schedule that deals with the capital gains tax legislation. This discussion can't be complex. It's a topic on its own. So it can't be comprehensive because the legislation is very, very complex. There are numerous inclusions and exclusions to the exclusions. The legislation is directed towards anti-avoidance. So try to use the exemptions so that you don't fall within it to start off with. And that is the best in all cases. So I'll focus now on certain definitions and certain exemptions. So a concession or a compromise is defined where a debt is cancelled or waived or just extinguished. So that in our example is if the managing director will go to a bank and say, you know what, I owe you R1 million. Let's reduce it by 300,000 Rand. I'll pay you 700,000. That 300,000 Rand that it is cancelled or waived falls within the definition of a concession or a compromise. But that definition of concession or compromise was also expanded because before this new Section 19, it was possible to just issue shares, obtain capital on shares, and use that in order to settle a debt. Use the proceeds from the share issues and pay off a loan. So it says a concession or compromise can be where a debt is owed by a company and that debt is settled directly or indirect by being converted into shares or by applying the proceeds from the shares. So what we used to do, a company would be insolvent and we'll say the shareholder will subscribe for 10 million Rand of shares. Okay, you flow the cash into the business, you take that 10 million Rand of proceeds on the issue of shares, and then you use that in order to pay back a loan to the same shareholder. So the loan gets extinguished, but that share is now not worth 10 million Rand, it's only worth R1 million, or it's worth 0, and I'll do an example of that a bit later. Okay, so even this indirect, where you use the proceeds, falls within the definition of concession and compromise. So it's very, very wide. Okay, a debt is also defined as any amount that is owed to a person in respect of an expenditure incurred by that person or loan advance to fund any expenditure. So it's also important through this, as you see later, that you need to know what the debt was used. It excludes a tax debt, which is also very interesting because, for example, if you compromise the tax debt with SARS, then there's no underlying recoupment or anything. For example, if you compromise, you delay the 20% payment of the PAYE, and you suffer problems, and you say, now I can't pay that PAYE. Effectively, you've overclaimed salaries because the PAYE was just an amount that you withheld from salary. You never paid that. There's then no recoupment of that because it doesn't apply to a tax debt that has been settled. Okay. Now, this is the important bit. It defines a debt benefit. Okay. So when there is, firstly, a concession or compromise, you only get taxed. There's only a tax event if there's a debt benefit. So there must be a debt benefit. So how does this arise? Let's look at this example. Okay. So let's assume this company, and before the capitalization, it's got share capital of 1 million, retained earnings of 9 million. So this company is solvent. This company has got a net asset value of 10 million rand. It is clearly solvent. It's got a net asset value of 10 million rand. There's a shareholder loan of 3.5 million rand, and there's certain then fixed assets and debtors and the like. But this company is solvent. It's got a 10 million rand net asset value, and obviously the shares in this company is worth 10 million rand. Let's assume it should be valued at net asset value. If you want to then capitalize, let's use that loosely, capitalize that long-term shareholder loan, or want to issue shares for 3.5 million rand and use the proceeds of that 3.5 million rand to pay back the shareholder loan, the journals would be debit the shareholder loan, 3.5 million rand, and then credit share capital. You can now see that the equity of the company goes up from 10 million to 13.5 million rand. Okay, so the values of the shares increased by 3.5 million rand, and the value of debt reduced by 3.5 million rand. So in this case, there is no debt benefit, because so you can never have a debt benefit for a company that is solvent and it's got a positive value on it. So this debt benefit can only happen if the company is insolvent. So let's illustrate that with this example. If you have a share capital of 1 million, but there are retained losses of 8.5 million rand. Okay, so the company is effectively insolvent of 7.5 million rand. Now that obviously creates a problem if company is trading under insolvent conditions. There are all kinds of liabilities that the directors can pick up. There's all kinds of disclosures that the company needs to make in terms of the Companies Act and the like. So the company sits with a shareholder loan. It's funded its business through a shareholder loan, and it says, well, I'm quite happy to convert that shareholder loan to equity. And doing that, I'll now recapitalize the business, and it will be positive assets again. So that 21 million rand, I either issue new shares. So generally the way it happens is there's a share subscription agreement for 21 million rand. And then where the shareholder is obligated, because you have to issue fully paid up shares. You must pay for that. Where the shareholder is then obligated to pay 21 million rand in terms of share subscription agreement. And then there is a set-off agreement where the liability of the company towards the shareholder of 21 million rand arising out of the shareholder loan is then set off against the obligation of the shareholder to pay the subscription price for the share capital. So you can see in this case, the net asset value of the company was negative. The shares in this company is worth nothing. It's worth nothing. So the share value is nothing. Can't have a negative value because it's a share. But effectively what's happened, by doing this, you've reduced the liability by 21 million rand, and then the company has moved into a positive situation. So the loan decreases by 21 million rand, and it increases from nil to a positive value of 22 million minus the 8.5 million rand. So that's 13.5 million rand. Okay. So apologies, not the 14 million rand. So what has happened, there has been a movement. So in this case, a debt benefit does arise. If the shareholder holds effective interest, so in this case, if it held 100%, then obviously a debt benefit would have arisen, because the company used to have a 21 million rand, but it now gave out shares worth 13.5 million rand for the balance. And therefore, there is then a debt benefit of approximately 7 million rand of the difference. Okay. So if it didn't have effective interest, then you have to do a calculation of what the value of the shares that person, obviously, if I had no effective interest, it means he had no interest beforehand. Then you calculate the value of the shares he had after the transaction, and then compare that to the value of the shareholder loan, and that will then be the debt benefit. So you can only have a debt benefit then, obviously, when a company is insolvent and you take it up to either a neutral position or to a solvency position. Okay. As you can see, then the calculation of debt benefit is quite relevant when a company is insolvent. Okay. So how does it work? You must find out what that debt was used for. So if the debt was used to fund trading stock, then you look at section 19. If it was tax deductible expenses, also 11E deductions, 12C deductions, you look at section 19. If it was used to fund capital assets, and you look at paragraph 12A. Okay. So the impact of combination section 19, 12A, if there's a debt benefit, you take that debt benefit, you see to what it was aligned. If it was aligned to a tax-deductible expense, you've got a recoupment of a tax-deductible expense. If it was aligned to an allowance that you claim, for example, if you have an E12C, you've got a recoupment of that. If it impacted trading stock, it adjusts the value of the trading stock and the expense on the trading stock. If it was on capital assets, then you adjust the base cost of any capital assets. Okay, so it becomes very, very complex because you've got to calculate the debt benefit. As you can see there, even though you have a full 21 million rand that you set off, your debt benefit may only be 13.5 million rand, and you've got to allocate that to wherever it belongs. So it is very, very complex to calculate these recoupments in practice. Okay. This is then important, as I said, I'll focus rather on the exclusions, because once you get into that scenario, you've now got to calculate these recoupments. Okay. The first section 8, A, B, and C are just outside business scenarios. It applies to employees. It applies when there's donation tax. It applies if you're a heir or legatee in terms of a deceased estate. Okay. Rather focus on 8D, E, and F. So, section 8D is the situation where you're part of a group of companies. Now, first, you need to understand that that's a group of companies as defined in section 41. A group of companies is defined in section 1, and that's wider. So that includes, for example, a PBO, a non-profit company, a non-resident company in that group of companies. But then section 41 is much narrower. It says section 41 defines a group of companies to be the same as section 1, but then excluding any companies that are non-resident, any companies that are PBOs, any companies that are NPC. So if it is within a group of companies, and then the company that has now got the debt benefit, it has not traded in the current or the immediately preceding year, then there's an exclusion for any debt that goes to the group of companies. And that was quite important, because if it wasn't for this one, remember, you lose your assessed loss if you don't trade. So you had an absurdity arising that you stopped trading, you had an assessed loss of 20 million rand, you stopped trading, and then you had a debt benefit as part of the process of deregistration, where there will be a compromise with your shareholders, and then you've got this debt benefit that you pay tax on, but you don't have the assessed loss that can shelter yourself. So this came in order to deal with this. Now that applies to all compromises. It's whether you settle it by way of a share or whether it is a direct compromise. And this is very valuable when you need to deregister a group company. So if a group company is suffering, then generally you try to deregister. And you can only deregister the company if it doesn't have any assets, it doesn't have any liabilities. So if the company is insolvent, generally what you do, that insolvency generally is because of a group loan account that it may have. If you just waive that group loan account, it will kick in. But if the company has ceased trade, then the exclusion will apply, and you do not have any recoupment section 9. The next one sounds very similar because it is also an exemption for a group of companies, also again only defined in section 41. Okay. But this only applies, it doesn't apply to general compromises. It only applies if you do it by the settlement of debt. Now it applies then to everything. If it's a group of company, and if you settle the debt by way of issue of shares. So within a group scenario, if a group of companies excludes non-residents, it excludes PBOs, NPCs. If you have a group of companies and you then inject share capital, you use the process of share capital to repay back the loan, it doesn't apply. And it doesn't apply to the capital value of the debt, but it also doesn't apply to any interest that has been capitalized. Okay. And 8F1 is then more wider. So this says section 19 also doesn't apply to the extent that the debt so owed is settled by an arrangement prescribed in paragraph B. So that is injecting share capital and then using the process of share capital to pay back the loan, but it doesn't apply to any interest. So this exemption can be used, for example, if a non-resident shareholder wants to inject more share capital and there's effectively a compromise from a non-resident, or where the shareholder is a public benefit organization, or the shareholder is a non-profit company, or the like. So, but then any interest, any capitalized interest, there will still be a recoupment of any capitalized interest. So that is the exclusions under section 19. Paragraph 12A, very similar, but it's not exactly the same. These exclusions are not exactly the same. So you have to go through them in quite some detail. So whenever there's a compromise or there's an injection of share capital of which the process is being used to settle any loan account, firstly, check whether the company is solvent. If the company is solvent and it's in a positive position and the market value increases, then it should be okay if you inject the share capital. If you purely compromise the creditors, the debt, then you need to look at certain of these exclusions. Be very careful on that. Okay. In this time, companies are raising loans. This is just a fact. I've had many queries from clients saying, we are now raising loans. What should we be worried about? So this is the case study 5. Your client is a subsidiary of a global group that manufactures, sells, and distributes beauty products. With a significant decline in demand for its products, the client has experienced significant cash flow and solvency problems. Its holding company is in Switzerland, and the Swiss company agrees to provide subordinated loan funding of 150 million rand. So it's a subordinated loan, and they ask you for advice regarding the tax consequences. So there's numerous things that one need to look at. And the first thing is just what the 2020-21 budget was talking about. In the budget, it talked about the curtailing of excessive corporate interest deductions. And this is not law yet, because the consultation was supposed to begin at that time, and then I've not seen this document. I'm not sure whether that was published yet. Okay. So government proposes to restrict net interest expense deductions to 30% of earnings. So we don't know what the earnings would be for years of assessment commencing on or after 1 January 2021. The measure will address a typical form of base erosion and profit shifting by multinational corporations, so transfer pricing. The practice involved artificially inflating company debt and or interest rate on that debt to a related party in another jurisdiction with a lower corporate income tax rate. The resulting interest payments are deducted in South Africa, reducing domestic tax base. They want to reduce it just to 30% of earnings. So this is exactly covered by a transfer pricing legislation. It's covered by Section 31, as you'll see later on. But there's no safe haven, and it seems that they want to legislate this whole process. Let's see what's happening there. Okay, but in the meantime, we have to consider the legislation. Now, over the past number of years, since about 2014, there's been many legislation that is substance over form legislation. So Section 8F and 8FA are typical substance over form. People say to me, 8F and 8FA are anti-avoidance legislation. It's not anti-avoidance legislation. The reason is, in this regard, 8F regards interest on hybrid debt instruments to be dividends in specie, but it does so in both the company paying the interest as well as the company receiving the interest. So it's then regarded as dividends for both parties. So this can actually work in favor of the taxpayer, because if the company paying the interest is in a tax loss situation and the company receiving is in a tax paying position, and if it's recharacterized from interest to dividends, then it would be obviously in the favor of that company. Okay. So what is a hybrid debt instrument? So whenever you raise loans, you've got to go through these different sections and see what are the terms of these conditions. Do I have a problem with perhaps that it becomes a hybrid debt instrument, that it must be there? So the first one, the definition of hybrid debt instruments include a situation where that instrument is convertible into a share. Okay, unless the market value of shares is equal to the amount owed in terms of the instrument. So that is the first category. Normally, you can solve that if the market value is equal. Okay. The next one is quite important, and that runs when you're looking at a subordination agreement. So the obligation to pay an amount so owed on a date or dates falling within that year of assessment has been deferred. So you've got to look back. You've got to look back. So at the end of the year, you say, was I obligated to pay an amount, but I didn't have to pay it because it has been deferred by reason of a subordination agreement, which is conditional upon the market value of the assets of that company not being less than the amount of the liabilities of that company. So this raises, if you have a subordination agreement that says you will only repay this loan once the market value of the assets exceeds the market value of the liabilities, then you fall within this, or potentially you fall within that if factually you do not repay the loan because of this. So you've got to look at the terminology of the subordination agreement. If you have a subordination agreement that says it will be delayed. The payment of this loan to the shareholder will only be made after all the creditors have been paid. It doesn't say it is dependent upon the market value of the assets exceeding that of the liabilities. It doesn't refer to that. Then you will not fall foul of that one. Okay? And the next one is that company owes the amount to connected party in relation to that person and is not obliged to redeem the instrument, excluding any instrument payable in demand within 30 years. Now, I've seen many things there. You have to be, there's got to be obligation. Obligation is a very strong term, to repay the loan within 30 years. If there's no obligation to repay it within 30 years, then it will automatically fall as a hybrid debt instrument. Okay? So you have, whenever you look at it, so for example, if you have an arrangement that you say you will repay this loan out of the profits of your business, okay, and you have an interest, you have everything on there, but clearly you don't know whether there will be profits. So there's no obligation within 30 years. You can't just do that. Okay. It excludes any instrument payable on demand. So if an instrument doesn't have any repayment terms, it is automatically regarded to be an instrument payable on demand. Okay. So for an instrument that doesn't have any repayment terms, it will be automatically fall outside this. Okay. So be very careful that you may fall within this. Just because you try to have a subordination agreement or you say that is payable out of proceeds from certain things, there must be an obligation to do that within 30 years. And if it falls within that, then it is a deemed dividend. And once it becomes a deemed dividend, if your shareholder is a non-resident or the holder of that instrument is a non-resident, then you've got a 20% dividend tax payable on it. Okay. All right. So it recharacterizes it for both parties. There is an exclusion to this, and that is if the auditors requires a subordination agreement, okay, purely to make them happy that they can sign off the financial statements of going concern, then the auditors need to provide a certificate, and then that paragraph B will not apply. Okay. So 8FA, so 8F is a hybrid debt instrument. 8FA deals with hybrid interest. So it says that where you pay any interest and it's not determined with reference to specified rate of interest or not determined with reference to the time value of money, okay, and certain various other requirements, then again, it will be regarded as dividends in both parties. So for example, if the interest says, if you've got a loan and it says you will pay 20% of your net income before tax as interest to me, no matter what it would be, then it's not determined with reference to specified rate of interest and not with reference to the time value of money. You can say that you will pay 10% interest, okay? But to the extent that the 10% exceeds 10% of your net income before tax, it will not become due and payable. Then it is still with specified rate of interest, okay? The reason for these kind of things, it says that the characteristics is, this is not the way that a loan works. You may call it a loan, but in actual fact, this is the way that a share works. A share will say, you pay me 10% of your earnings. It is not a loan. So it will look at the characteristics and say, this is substance over form. Substance, you call it a loan, but in substance, it is an equity instrument, and therefore the return on it will be deemed dividends in both parties. So these are substance over form legislation. Okay. I mentioned Section 31 quickly, and obviously this is a very complex section, and you need specialist advice on it. An effective transaction is a transaction between a resident and a non-resident that are connected parties. So your transfer pricing legislation doesn't apply between two residents. Okay. And it applies where any term or condition of that transaction, operation scheme, agreement, understanding is different from any term or condition that would have existed had those persons been independent persons dealing at arm's length. And that is the overriding principle. Would I have entered into exactly the same thing if we were not acting at arm's length? Okay. So it's complex legislation. It applies to foreign connected party transactions. So make sure when loans are raised from non-connected parties that the company is not thinly capitalized and there's no safe haven, safe harbor rules. Ensure that the interest rate is not excessive. If you're thinly capitalized or the interest rate is excessive, there will be a dividend withholding tax of 20%, but interest withholding tax is still payable because the interest withholding tax is a tax on the recipient. So the recipient, it's still interest. So you can have a disallowed interest. You can have interest withholding tax payable. Obviously, in that, you can still use the DTA if there's reduced rates. And you can have a 20% dividend withholding tax, which you cannot use the DTA because it's not a true dividend. So your client is now approaching you and asking you whether you can raise the loan and what he should consider. So you first told him you need to consider Section 8F, the terms and conditions, if there's any subordination, if this loan is not repayable within 30 years, you may have all kinds of problems arising from that. You said 8FA, because you've got to look at the way that the interest is calculated. It's got to be calculated with reference to time value of money. So then you do not fall foul of Section 8FA. Then you have to look at Section 31 and to say you can't be thinly capitalized. The interest rate should be market related so that you don't fall foul of your transfer pricing legislation. But you're not finished there. You've got to look at Section 23 Cap M as well. And that relates to interest on loans to parties in a controlling relationship. Okay. So Section 23M says that where an amount of interest is incurred by a debtor during year of assessment in respect of a debt owed to a creditor that is in a controlling relationship with that debtor. So the definition of controlling relationship is a direct controlling relationship. So it doesn't apply to all group debts. So if you have a loan from a sister company, this may not apply. If it is from a sister company but it was funded from the controlling relationship, then it may apply. Okay. So, and if there is interest, but that interest is not subject to tax in the hands of the person to whom the interest accrues, okay, and it's not disallowed under Section 23M, then 23M kicks in to disallow potentially a portion of that interest, okay. So, so the first question is, it's not a permanent disallowance. To the extent that it is disallowed, it gets carried forward to future years, okay? And to the extent that it is now deducted, then obviously it doesn't get carried forward, okay? This doesn't only apply to non-resident companies. It can apply if the shareholder, if the controlling party is a public benefit organization, and that public benefit organization doesn't pay tax on this interest income. Okay, so it can apply to any creditor that is in a controlling relationship. Okay, it also only applies. It doesn't apply if the interest was subject to tax in the hands of the person to that interest accrues. Okay. So if it is a non-resident, if the non-resident pays interest withholding tax on it, then 23M doesn't apply. Okay. Your problem is there's a timing difference with your interest withholding tax. Interest withholding tax is payable when the interest is due and payable. Okay. So you may have in a company's year, let's assume your year end is December. Okay. And the interest is only due and payable maybe 3 months after year end, but the interest is calculated in terms of 24J on the yield to maturity basis. So to the extent that you've accrued interest, but it's not yet due and payable under the interest withholding tax regime, it has not been subject. So the mere fact that once it becomes due and payable, it would be subject to interest withholding tax doesn't mean that you get out of 23M, because 23M, it applies to a year on an annual basis. It will next year become due and payable, and then the component that's disallowed will be carried forward. So there's often a misconception that says that if you're liable for interest withholding tax, then you don't worry about 23M. You must still need to worry about a component of it because the component to which it has been subject to 24J, but not yet subject to interest withholding tax because it's not yet due and payable, will be subject to the 23M calculation. You will have to do the 23M calculation. If there's a reduced rate, so for example, the interest withholding tax reduces to 5%, it is still subject. It's okay, but it is more a timing issue than anything else there. So be careful for that. And as I said, it will carry forward. It's different from Section 23 Cap N, which provides for a permanent denial of this. So you don't only stop on on your Section 8F, 8FA. You don't only stop on Section 31, you also have to look at Section 23 Cap M. Now, that limitation is formula driven, and there's a formula in terms of which you need to calculate. It's calculated based on on the adjusted taxable income of the company, and that formula is quite complex. I have prepared a template for that and a calculation method. So if there are people that are interested, just contact me and we can talk about it. The issue of what do you do if you now issue shares? Because if the company then says this is too difficult, I'm not going to issue loans, anything, I'd rather take up shares. You can't just accept it, because you've got to think about whether Section 8E is applicable, and that is where the issuer of the share is obliged to or can redeem the share within 3 years, and then the recipient is then deemed to have income on this. Now, this you can see is anti-avoidance, because it's not deemed to be tax deductible and taxable. In the hands of the party paying the dividend, it's still a dividend. In the hands of the company receiving it, it is then regarded to be income. So 8E must be avoided. It must be avoided because you must work your way around it so that you don't fall foul of these 3 years rules. Okay. 8EA is dividends on third-party backed shares, and again, it's anti-avoidance. And effectively, it says that if you got third-party backed share, then it's not really you don't take the risk on the share. So if you have a share in a company, and if that share must be, for example, redeemed, but you can put it to a different party that will pay it to you, then it is almost a guaranteed share. Then it falls within third-party backed shares, and then again, the income, the dividend, is then regarded to be taxable income in the hands of the recipient. Again, it's complex legislation. Need to work your way out of it, because there are all kinds of exemptions for qualifying purposes for these kind of shares. Okay. This is interesting because once you raise the loan, that doesn't come cheap. You've got to pay certain things in order to raise the loans. So let's look at what the tax treatment would be of things like raising fees or front-end fees, guarantee fees, commitment fees, holding fees, legal fees, consulting fees to raise that money. It is important to note that the definition of interest was amended in 2016. Now, currently it reads in Section 24J, it includes the gross amount of any interest or similar finance charges, discount or premium payable or receivable in terms of or in respect of financial arrangement. It used to read not similar finance charges, but it used to read related finance charges. Okay, there was a court case that found in the context of Section 11BA that a related finance charge is quite wide. It included in related finance charges raising fees, even your consulting fees and legal fees and the like. But a similar finance charge, why was it changed? A similar finance charge, I believe, narrows the definition of interest. It must be similar. So let's test these kind of fees. Obviously, once you pay interest, the normal interest in terms of 24J, on the amount of money that you physically borrow, the time value of money, that will be interest and will straight interest. Now, similar finance charge, if you have a raising fee, what is a raising fee? It is a fee that is not calculated with reference to the time value of money. Okay, so interesting enough, if it wasn't for this amendment, and if it's regarded as interest, then it would immediately have been recharacterized to dividend, because it would have fallen foul of Section 8FA, because 8FA says if you have any interest that is not determined with reference to the time value of money, it is deemed to be the dividend for both parties. So raising fee, if it was not for the change in definition of interest, if it was still fall within the definition of interest and was a related finance charge, it would have fallen foul of 8FA. Okay, so for now, I strongly believe that a raising fee is not interest, because it's not payable for the use of money. It's payable for all the work that you do upfront in order to get the money. You pay it once off, and there's VAT on it as well. Okay, so the SARS practice manual, before that court case, talked about the tax treatment of raising fees and dealt with it under Section 11A. And it looked at the application of the money. If the money is raised, if the loan is raised with a purpose to buy capital asset, to, for example, build a building, expand the factory, or doing anything like that, then the raising fee will also be capital. But if the money was raised in order to fund operation capital, to buy stock, to pay salaries and the like, then the raising fees will be tax deductible. Okay, becomes interesting if you have a raising fee in order to refinance an existing loan. Arguably, the raising fee will then not be tax deductible, because that existing facility can be a capital facility, and if you want to refinance that existing facility, then it could then be capital in nature. depends on whether that facility is also long-term or short-term. Okay. The guarantee fee is generally paid as a percentage of the amount of money that you have borrowed. So if you have a facility of, say, 100 million rand, and you have borrowed 60 million rand of that. So the guarantee fee may be 0.5% of 60 million rand. And sometimes you pay that to a group company. Sometimes you pay that to a bank. Sometimes you pay it back to a third party. And the argument there would be is that this is similar to interest, because arguably the cost to raise finance would be cheaper if the loan is guaranteed than if the loan is not guaranteed. So if you have, for example, a loan that's 8% and you can pay to your holding company 0.5% of that as a guarantee fee, it means your overall cost of finance is actually 8.5%. And that will be cheaper than, for example, having to pay a fee of, say, 9% for a loan that is not guaranteed. So the argument there is that a guarantee fee is similar to interest. Now, an interesting context of this is that if you pay that guarantee fees to a holding company that's a non-resident, what would that then be? If it falls within the definition of interest, that will then be subject to interest withholding tax. But the argument will also be that it will then have the benefit of the double taxation agreements on that. So paying a guarantee fee to a holding company may be subject to interest withholding tax, and be careful around that definition. The commitment fee of a holding fee. Now, in my previous example, you've got a facility of 100 million rand. You pay your guarantee fees, you pay interest on the portion that you have used. So you've used 60 million rand. The commitment fee is you actually pay a fee of, say, 0.5% on the amount that you have not used, you've not drawn down yet on that 40 million rand. And that is really a fee because the bank needs to have that money available to you. So contrary to popular belief, the bank doesn't just have money freely available to lend out. They have certain ratios that they've got to maintain, and in order to do that, they need to go through a process. And to compensate them for having the money available for you, pay them a commitment fee. Arguably, it could be a similar finance charge because it is related to the time value of money. It's payable on a monthly basis or on a daily basis. Or arguably, it could just simply be deductible in 11A because you don't get an enduring benefit of it. If you don't pay at the end of the month, then that facility will go away. So it doesn't have enduring benefits. Arguably, either deductible on 11A or as a similar charge. Then your related fees, legal fees, consulting fees. Argument there would be that it would be similar to the raising fees. It is if the purpose of the loan would be to buy capital assets, to buy a business, to buy anything like that, it would be deductible. If the purpose of the loan would be in order to fund working capital, arguably it could be tax deductible. Okay. What about the VAT? So the VAT is, what are you going to do with the money? If you're going to use the money to buy a factory or to do expansions to a factory, that's going to raise the number of units that you produce from 1,000 to 1,500. Your taxable income from a VAT perspective will increase. Then the argument would be that you can claim the VAT on the raising fees. If the raising fees is paid to a non-resident, there will be no VAT on imported services. Okay. And that will apply for most of these kind of costs. But be very careful because SARS argues that if you are incurring certain raising fees, it is there to raise the loan, and the loan is an exempt supply, or money is not goods, and therefore the VAT is not deductible. So there could be a costly disagreement with SARS, but there are contrary views in this regard. Okay, so be careful on the VAT side as well. Just know that VAT is payable and obtain proper advice before you implement this. Okay, let's look at closure costs. This may happen quite often over the coming months. So let's assume your client runs 5 pizza outlets under a franchise agreement in a single company structure. Okay, it rents premises and employs 76 employees. Your client decides that it would be best to close down all 5 outlets, pay retrenchment costs, pay an amount per store varying from 100,000 Rand to 350,000 Rand to cancel the lease agreements for the property leased, pay an amount of 500,000 Rand per store to the franchisor to cancel the franchise agreements per store. And the client asks you what are all the tax treatment of all of this. So if you look in the guide on the taxation of franchisors and franchisees, it actually deals with this scenario. And it says that what happens to the compensation paid by a franchisee for early termination of a franchise agreement. So it says a franchisee may prematurely terminate the franchise agreement for any number of reasons, most often because of unforeseen financial difficulties. The franchisee would in these circumstances most probably be required to pay compensation to the franchisor. Okay. So it said the compensation paid by the franchisee to the franchisor in these circumstances cannot be said to have been incurred in the course of its ordinary income earning operations, but rather because of the discontinuance of its business operations, income earning structure. The expenditure would accordingly in most instances be properly classified as being capital in nature and not deductible in Section 11A. Furthermore, the provision of Section 23G will prevent any deduction as the expense will be regarded as money not laid out of expenses for the purposes of trade. So on the face of it, you would have a problem because you're closing the business down in its entirety. Similar factors will apply for the lease agreements because you're closing down the business in its entirety. Sometimes it doesn't really matter because that will create assessed losses. You only close down the business when you've got assessed losses. You're going to forfeit these losses in any event. But it really does depend on the scenario for each case. Okay, so be careful because that costs can be regarded as non-tax deductible. Okay, insofar as the retrenchment cost is concerned, it becomes more tricky because especially if you pay the retrenchment cost as prescribed by law. And by law, you have to pay the person 1 week for every completed year of service. And one can strongly argue that you've actually picked this up. You've incurred this obligation, even though it's triggered by the retrenchment of the person, that it was incurred by law. But clearly a very, very difficult scenario to find yourself in. Okay. So what happens if you pay interest or leases after the closure of the business? Then there is no trade. So, for example, if there's a loan and you're not settling the loan, you couldn't settle the loan itself, and you just continue to pay the interest, then obviously there's no trade, and you will be precluded from paying that interest after the business has now settled. The same may apply for the rental of premises. You've closed it down, but you can't get out of the premises, and you pay. And some of these costs can be a bit of a problem. Okay, so what will happen if you don't close down all 5 stores, but you just close down 1 or 2? Your position will look much better because clearly you're still trading, and as an entity you're still trading, so you don't have to worry about the trading requirement. You can even argue that it is also in the production of income, because if 1 or 2 bad stores may pull down the entire business, it will be still in the production of income by paying the retrenchment costs, getting out of these lease agreements, because overall you need to make these payments in order to stop the bleeding so that you can maybe focus on some of the more profitable businesses and carry on from that. So your position will look much better if you just close down 1 or 2 of the stores than closing down all 5 stores. But it can also be argued. The capital side of it is a bit more tricky, because if, for example, clearly your franchise agreement is part of your capital structure, your lease agreement is part of your capital structure, it is the right to occupy the premises. If you don't pay an amount and there's still quite a period left of the lease agreement, or there's a period left on this, can be seen as an extinguishment of a capital asset and capital interest. So even if you meet the trade requirement, you meet the requirement of the production of income, it may still be regarded as capital nature. If you've got 2 or 3 months left and you pay an amount, you get out of it, perhaps you can say, well, it's not really part of my capital structure anymore. But payments to get out of long-term contracts is fraught with difficulties. That should generally still be claimable on these cancellation fees, and should still be okay. Okay. So let's take case 37. Your client is a franchisor of the pizza outlet. So now we're looking at the situation from the franchisor. So to reduce the administration of the franchise agreements and to ensure the long-term viability, it decided that any franchisee, you must operate at least 5 outlets. So what they do is they approach every franchisee who has got less than 5 stores, and they offer them 5 million rand per store to cancel that agreement. Okay, so you're now required to provide advice, because they say, hang on, we can't deal with so many different franchisees. It's just becoming so difficult. We only want to deal with the big guys. You have to have at least 5 stores, otherwise you can't be part of our franchisee network. So let's go to everyone, offer them 5 million rand to get out of it. Okay. Again, the guide on franchisors and franchisees deals with this. Okay. And it deals in 3.7.1. It says that a franchisor may cancel an agreement with a franchisee before termination of the franchise agreement for any number of reasons, such as the following. The cancellation of a franchise agreement by the franchisor in order to replace a current franchisee with a more competent franchisee. And your previous example, it may fall within that, because a capable franchisee is a person having a number of stores. He's got 20 stores. He's much more streamlined. He's geared to do it. And in that case, everything would be better. In that case, SARS says you can have a deductible expenses under 11A. You still argue that that can be capital in the hands of the franchisee, because obviously that's a sterilization of a capital asset. Okay, but you can argue. If the franchisor is saying, well, I'll pay you out because I'm going to buy your business, then it will be capital in nature. So it's interesting, even though your gut feel will tell I'm paying an amount to get out of a long-term franchise agreement, the actual fact is from a franchisor, this is the scheme of profit making. They enter into franchise agreements, they're constantly getting new franchisees, getting new initial fees, and they are effectively training and churning the franchise agreements. So don't just accept this because the circumstances of your scenario may be that it may in fact be a capital deduction. So you've still got to look at it on its own merit. VAT should be payable and claimable. It should still be all okay. Okay. And it also says that with regards to the position of the franchisee, it will generally be regarded capital in nature. Okay. Let's look at case study 8. So your client operates numerous hardware stores across Gauteng. Management believes this is a good time to expand. It believes that some of these stores they can pick up at a bargain purchase, and they can have a long-term return investment. They've got enough cash to buy this, and they believe they will be able to turn it around. So they say, well, we're going to incur due diligence costs and professional fees, and what should we do on these costs? So due diligence and related costs, from an income tax perspective, is generally capital in nature. No matter what you're going to buy, when you buy shares or when you go buy business, it doesn't really matter what it would be. It will generally be capital in nature. Okay. But it's important that you define what assets, whether it's a share or a business, because if it's a share, you can probably add these costs to the base cost of those shares. When it's a business, it becomes much more difficult to add it to the base cost of the business, because as we'll talk at a later point, a business is not a single unit, a single asset. It's a combination of assets. From a VAT perspective, you need to consider, because obviously there's VAT on the due diligence cost and the related costs. From a VAT perspective, you need to consider what is being claimed, what is being acquired. If you're doing a due diligence in order to buy shares, then obviously you can't claim the VAT on the due diligence cost as input tax. If you're going to buy the business as a going concern, you have to say, what is this business doing? If it is a short-term insurance company, you can claim the VAT on it. If it's a long-term insurance company, you can't claim the VAT on it. So you need to make sure if the business is making taxable supplies. If the business is going to make exempt supplies, you can't claim the VAT on it. If it's going to make due supplies like a bank, you can claim a portion of the VAT on it. Because the VAT Act is not concerned on whether it's capital or not. The VAT Act is concerned on whether that will lead to future taxable income from a VAT perspective. Okay. So let us discuss now the tax consequences if there is a sale of a business as a going concern, okay, not using corporate rules. Okay. So let's take this example. It's more or less the same example as what I had previously. You have this is the target business. Now remember, you're going to sell the business as a going concern. The company has got share capital of 1 million, retained earnings of 9 million. So it is in a positive net asset value. The fixed asset cost is 15 million, accumulated depreciation of 5 million rand, debtors of 10, bank of 1 million, your provision for leave pay and bonus of 2.5 million rand, a warranty provision of 1 million, trade creditors of 4 million, and long-term loan of 3.5 million rand. Okay. So effectively, and they say we're going to sell this business at net asset value. Okay, that is quite important, because I'm going to sell that business as net asset value. Okay. So when you look at Interpretation Note 94, a very interesting and correct statement is made in paragraph 4 that I'd like to highlight. The business as a whole is not recognized as a single asset for income tax purposes, The business consists of a collection of assets and possibly liabilities, and the total purchase price must be allocated to the individual assets and possibly liabilities which form the subject matter of the sale. An allocation of the purchase price to individual assets is required regardless of whether the sale agreement reflects the purchase price as comprising a lump sum, net amount, or as an itemized list of assets, less liabilities, and contingent liabilities. And this is so true. Many sale businesses, in this previous example, would say, we hereby sell the business as a going concern for 10 million rand. That's it. That is not what is happening. You are selling fixed assets. Obviously, your fixed assets you're selling it for 10 million rand because it is the net asset value or the book value or the fixed assets is 15 million minus 5. You're selling fixed assets at 10 million. You're selling debtors for 10 million. You're selling your bank account, the positive bank balance, that cash for 1 million rand. So you're selling 21 million rand of assets. You're not selling the business for 10 million. You're selling 21 million rand of assets. You're selling fixed assets. You're selling debtors. You're selling bank. You can also not sell liabilities. The liabilities you assume in payment of these assets. So you're not selling the business for 10 million rand. You are selling assets of 21 million rand, and you're paying for that assets, okay, by assuming the obligation to repay long-term loan for 3.5 million rand, by assuming the obligation to pay the trade creditors for 4 million rand. Yes, also by assuming the warranty obligations, because once this, you will then honor any warranties that will come forward from warranties that you've given, and you will assume this, and this is valued at 1 million rand. You will assume the obligation to provide paid leave to employees and to pay them a bonus when it occurs, and if they are still in employment, for 2.5 million rand. And then the balance of the 10 million rand is settled in cash or by the loan. You see the very difference. And so many sale of business agreements just simply says, we sell the business as a going concern for 10 million rand. It's an absolute misconception. Okay. And this is confirmed by SARS in interpretation at 94. The purchase price allocation is required irrespective of whether the purchase price exceeds or is less than the book values. Okay. Now, SARS would generally apply the purchase price allocation specified in an agreement of sale to both seller and purchasers. That assumes that there is a purchase price allocation. But if you deal with this, if you're advising your client on a sale of a business going concern, please tell them they have to allocate the purchase price on the basis that I've explained just now. SARS may apply a different allocation if there's evidence to the effect that the specified allocation does not represent the actual facts and the true intention of the party. So SARS can say, listen, you have allocated too much to goodwill, too little to fixed assets, I'm reallocating it. Okay, makes it even worse because once you've got your business combination IFRS statements, then the accountants will also do a reallocation based on the market value of it. Okay, so SARS may review the purchase price allocation adopted by the taxpayer when agreement of sale does not specify the purchase price allocation. You see how important this is to have a purchase price allocation. So let's look at the position of the seller. So remember the seller is a company. It's now got all of these assets, and I've just put the debits and credits in one column. The sale journal will be as follows. As I said, you take the fixed assets, you take out the accumulated depreciation, take out the debtors, the bank provision for leave pay, and there will be a loan account. So after the sale, you have a share capital of 1 million, retained earnings of 9 million. Instead of net assets of 10 million, you've got a loan account for the buyer. You don't have any more long-term loans. You don't have any obligations to warranty provisions. You don't have any obligations for leave pay to the employees, everything. You don't have that. But you have sold your fixed assets for 10 million. You've transferred your debtors for 10 million, your bank for 1 million. So you've sold assets of 21 million rand, and you've only received 10 million in cash, but the purchaser have assumed this. And this is very important. So if there is a recoupment on fixed assets, if there's a difference in the tax value of assets, if your tax value on the fixed assets is 7 million, you have sold those assets for 10 million, you've got a recoupment of 3 million rand in terms of 848. If your tax value of the assets was 12 million and you sold it now for 10 million, you have got an 11.0 deduction for 2 million rand. Okay. The debtors, your base cost for the debtors is 10 million rand. You have disposable 10 million rand. You can't claim 11I deduction by saying you've got less than it. You've received 10 million rand, which was the face value, and the same for the cash. Okay. So as you can see, you have actually sold assets. You do not sell whole business. You sell fixed assets. You sell debtors. You sell bank. And for that, you assume certain obligations. Okay. Now the problem comes in, how do you do the tax treatment? And I've said to you that the fixed assets, you can have 11O deduction, 8.4A recoupment. If you sell it at more than original cost, which clearly is not the case in this case, you can have a capital gains tax deduction. Just note on that, if you sell the business to a connected party, just remember you can't get an 11O deduction if you sell your fixed assets to a connected party. Okay. Now let's talk. The rest would be okay because your long-term loan is taken over, trade credit is taken over. But the big problem comes in with the provision for leave pay bonus and the warranty provision. Because this was dealt with in appeal court case of the Ackermans case. And the Ackermans case, in my view, was wrongly heard. Because in terms of the Ackermans case, effectively they said, we will sell this business for 10 million rand. We'll sell the business for 10 million rand. And the court found, they said, hang on, what they wanted to do was to claim a tax deduction for the 3.5 million rand leave pay bonus warranty provisions. Because effectively, you have sold assets for 21 million rand, but you got only 10 million rand for it because it was paid for. In reality, this is expense. For accounting purposes, remember the debit is an income statement. The debit of that 2.5 million rand is income statement. The warranty, the debit is an income statement. It has been expense. Effectively, it is a double-edged sword. Effectively, I've given the purchaser assets worth 21 million rand partly, so to get out of this 3.5 million rand of warranty provision, leave pay provision, bonus provisions. So there's a double-edged sword. I gave them this cash of 1 million rand. I've given them debtors of 10 million rand. I've given them fixed assets. So effectively, I've settled that obligations by giving the purchaser these assets worth 21 million rand in settlement of all of this. But the court found against it, and this is an appeal court case, you've got to follow it. In Invitation Note 94, it says that if a purchaser assumes a freestanding contingent liability as settlement or part settlement of a purchase price of an asset, the seller will not have incurred any expenditure on assumption of the freestanding contingent liability by the purchaser, which is obviously nonsense because, as you can see, I've only got 10 million rand, but I disposed of 21 million rand of assets. And the reason was 3.5 million rand of my debtors on my bank and my fixed assets went to this. But the court found that the mere fact that you get less for your assets doesn't mean that you've incurred a cost for this. Okay. The court did find that, or Interpretation 94 does recognize that you can structure your way around this. So there are ways that you can restructure your ways around it. And if your clients are faced with these problems, or you faced with these problems, please don't hesitate to contact me because there are very proper ways in which you can get out of this. Okay. So by the end of the day, what you're faced with is that from accounting perspective, you clearly would have expensed the 3.5 million rand. And that would have been expensed in net income before tax. You have to, in terms of the Ackermans case, if you structure it this way, have to add back the 3.5 million rand on the date of the transaction is a non-deductible expense. So it is a bit of a problem. In the Ackermans case, counsel for the taxpayer remarked and said, but if I don't get a tax deduction, then the purchaser can't, then nobody gets a tax deduction. And the court held as just a side remark, it said that, no, but the purchaser can get a tax deduction. It was not fined in that, but it was just a side remark. So let's look at the position of the purchaser. So let's assume this purchaser was a newly formed company. It had share capital of 1,000 and money in the bank of 1,000. So effectively, when they bought the company, this was the accounting interest. It was credit loan liability. It probably only brought in the fixed assets at 10 million. Sometimes they'll bring in the fixed asset cost and the accumulated depreciation, or just the net amount of 10 million rand. The tax cost is only 10 million rand for second-hand goods. So the debtors will be 10 million rand, the bank is 1 million rand. So clearly it's acquired 21 million rand of assets. And now in payment for that, they have assumed the obligation for leave pay, warranty provisions, trade creditors, long-term loans. And then the cash outlay would be 10 million rand. Okay, so there will be the cash outlay ultimately over time will be 21 million rand because now there's a loan account liability of 10 million rand that it will have to settle. It will have to pay the seller the 10 million rand. It will also have to pay the long-term loan of 3.5 million rand. It will have to pay the creditors 4 million rand. As the warranty realizes over time, they will have to honor those warranty provisions or pay out cash. They'll have to pay 1 million. As the people take leave pay, they will have to pay them salaries during that period, and they will effectively pay that, and the bonuses, they will pay them 2.5 million rand. So that will cash outlay. Contra to that, they will get a tax deduction for the fixed assets of 10 million, and they'll have a base cost of 10 million rands on the debtors, and they'll have a base cost of $1 million on there. Okay. So that is effectively what happens. The buyer acquires assets of 20 million rand and settles the purchase price by loan account of 10, assuming fixed obligations for actual liabilities of 7.5 million rand and assuming contingent liabilities for the 3.5 million rand. Okay. Now, what is the position of the buyer? Interpretation Note 94 draws that link. It says, from the purchaser's perspective, the assumption of freestanding contingent liability is a means of settling or partly settling the purchase price payable for the asset acquired, and as such is directly related to the acquisition of the assets. It's exactly as what I've said here, is that in payment of that 20 million rand of assets, they have assumed 3.5 million rand of contingent liabilities. Okay, it's exactly what Saul says. Accordingly, when determining the purchaser's entitlement to a tax deduction or allowance for the amount of freestanding contingent liability, assumed at the date of sale, it is necessary to look at the particular asset acquired and the applicable deduction provisions. Okay, so it says the expenditure has arisen as a direct result of the purchaser's assumption of the freestanding contingent liability, which was assumed as a means of settling the purchase price payable for the assets acquired. It was an undertaking between the purchaser and seller. Accordingly, in determining the capital revenue nature of the expense, the nature of a particular asset must be ascertained. Under the above example, the expenditure is of a capital nature because it was incurred as a result of the acquisition of a fixed asset, which are part of the purchaser's income producing structure. So then it says you can't get a tax deduction as you pay that provision for leave pay and warranty provision, which will also be exactly the same from accounting perspective. Accounting, when you pay that, you credit back your debit provision for leave pay, debit provision for bonuses. It doesn't go to the income statement. When you honor the warranty provision, credit back debit warranty provisions. Okay, it doesn't go to the income statement. So in the purchaser's hands, according to SARS, you will then have equilibrium between accounting tax. But you can see now you run the real risk that neither the seller nor the buyer will enjoy a tax deduction for contingent liabilities. And this is a significant problem, and you need to manage yourself out of that. And you need to obtain, because there are ways to get out of it. There are legal ways to get out of it. But it needs to be planned up front. Once you've done the contract, it's too late. You need to make sure that it happens so that you can have equilibrium on that. Okay. The one outway that is drawn in Interpretation Note 94, and in my mind, it is incorrectly so. And it says that if you're applying corporate rules, so remember this example is outside corporate rules, it says that if you are applying corporate rules, then the purchaser, if they then pay the bonus, if they pay the salaries, if they provide the leave, the purchaser can get the tax deduction. So the reality is that the seller still can't get a tax deduction. And there's an inequilibrium between accounting and tax, because the seller will recognize the expense for income, for accounting purposes, but for tax, you can't. So therefore, you have to add it back as a permanent difference on the date of the transaction. In the purchaser's hands, if you apply Section 4247, you effectively potentially can get a double deduction. So for example, if you buy stock, your stock is 10 million rand, you buy that with the assumption of a warranty provision and leave pay provision, a bonus provision of 10 million rand. Okay. That stock, as you expense it, you're not going to, as you expense it, you claim an income tax deduction. Now with 42 and 47, if you do it through 42 and 47, as you pay the salary, as you bonus, you get another deduction. So even though you've got only a cash outlay of 10 million rand, your tax deduction would be 20 million rand, one through stock as you deduct it, and secondly through this deduction. Only if you apply corporate rules. Okay, so there is an exemption if you apply corporate rules, but now obviously you get potentially a double deduction, where from accounting perspective there's then a deferred tax implication on that. Sometimes when they apply that, they will bring this into the purchase consideration as well. A lot of care needs to be taken when businesses are settled going concern in particular, and there will always be certain contingent liabilities. Okay. Let's talk about assessed losses and also what is said in the 2021 budget. When a company's tax deductible expenses exceeds its income, it records an assessed loss. Okay? Often the loss is carried forward to the next year and is offset against taxable income in that year. Over the past few years, there has been international trend to restrict the practice. Now, in most overseas countries, you can carry forward your assessed losses for a period of years. You can carry forward for maybe 6 years and then you forfeit. If you don't use it within 6 years, you forfeit it. The South African legislator intends from years of assessment commencing on or after 1 January 21 govern is that you can only offset an assessed loss against 80% of your taxable income. So in the next, if you have a 10 million rand loss in the current year, assessed loss in the current year, next year you would have a 10 million rand profit. Okay, then you can only offset 8 million rand of the assessed loss against that profit. So you will pay tax on 2 million rand. And this is generally a problem as the economy takes a plunge, because you generate tax losses, and as you recover, it takes you another 3 years to work off your assessed losses that you've made in 1 year. So in this way, it's only on that 80%. So obviously, one need to look at how you're going to recognize that also from an accounting perspective. Okay. Other assessed losses, remember, no trade, no assessed loss brought forward. So if you don't trade in a year, last year's assessed loss, you just automatically can't bring it into the current year. And that often is an issue because you may stop trade, you may have money in the bank, next year you may receive interest on that money, you may have a big assessed loss in the prior year, you don't receive any, you have to pay the tax on the interest, you can't offset the assessed loss on it. It often happens in a group situation where you sell your business as a going concern, you have an outstanding loan account, the loan account attracts interest, you have stopped trading, that intercompany loan account is not trading, and you cannot claim it. Okay. A capital loss, it doesn't have a trade requirement, so you can carry it forward. Under Section 103(2), it prohibits trading in assessed losses. So if there is a business that's acquired as, if you have an assessed loss and you move taxable income into that business, and generally goes in with change in shareholding, then SARS can deny the offset of the assessed loss against the income earning capabilities that is brought in. So these are anti-avoidance measures to stop you from trading in assessed losses. I want to thank you for your attention for today. I hope this has been a valuable session as you are assisting your clients through this difficult times, assisting them to raise finance, assisting them to negotiate compromises with creditors as they are considering the tax position of assessed losses, as they need to consolidate their businesses. I hope that you've enjoyed it. In the webinar of Tuesday, we will explore what's next, the long-term impacts of this, and Lulu Kruger will join in the presentation and discuss the economic aspects of that as well. Thank you for your time and have a lovely day. Bye-bye.